Hi, folks. My name is Eric Crittenden. I'm the CIO at Standpoint Asset Management. I've created this video and spreadsheet to show you how I would go about setting realistic expectations for bond returns in the future. Let me show you what I'm talking about. So this chart here is basically just the yield on the 10-year U.S. Treasury going back to 1951. It should look pretty familiar. You've got the rising interest rates in the 50s and 60s. You got the stagflation during the Jimmy Carter era, and then you had the 40 years of beautifully declining interest rates that we all benefited from. This red line represents the current date, which shows that anything to the right of that is obviously hypothetical simulated data. And that's the point of this spreadsheet. I'm simulating different future interest rate environments and trying to give you a feel for what the returns would likely be in those different environments. So up here, there's instructions, press F9 to recalculate. I'm going to do that. And notice that each time I press F9, I get a different future scenario. I've got declining interest rates. I've got kind of sideways interest rates, highly volatile spike down and then a spike up, all these different scenarios. And then over here, I've got a formula that essentially looks at those scenarios and the changes in interest rates, and then it calculates what the likely total return would be. Now, the formula is not perfect because there is a non-deterministic component to a bond return that has to do with the slope of the yield curve when you roll that bond. You have to roll the bond every year to maintain a position in a 10-year bond. However, the formula is very, very close. So I'm confident that it's a pretty good proxy for setting return expectations going forward. So again, if I press F9 a few more times, you can see what the returns would be for these different scenarios. And then down here, I've got the annualized return calculation. So this becomes powerful if you can do this hundreds of times and maybe even say 1,000 times and then plot them all in a cumulative probability distribution, which is what I've done on this page here. So if I scroll all the way down to the bottom, you can see that there has been 1,000 trials, and therefore I've calculated 1,000 different annualized returns, and then I've pasted them in here. I actually wrote a macro to do this. I didn't push the button 1,000 times. And then I sorted them from worst to best. And this blue line is just simply a plot of that. Now, the way you interpret this is a cumulative probability distribution, is you can move from left to right. So we know there's 1,000 data points here. So if we go from 0 to 100, well, that's 10%. So this is saying that there's a 10% chance that your annualized return going forward is going to be about negative 80 or worse than negative 80 basis points. Likewise, there's about a 30% chance that your annualized return is going to be worse than zero. There's a 50% chance that your annualized return is going to be worse than positive 56 basis points, so on and so forth. I'm sure you get the point. I've got these two horizontal lines on there to represent the frictions associated with investing. And one of them is, we all have to charge fees. And I chose 1% as representative of a typical advisory fee. Now, this analysis is suggesting that given current interest rate levels for all these different scenarios going forward, the expectation is that about 66% of those outcomes have a return that's lower than the advisory fee you're charging if you're charging 1%. Not very good news, I know, but don't shoot the messenger. The red line represents the combination of a 1% advisory fee and whatever your inflation assumption is. So right now I've got inflation set at 1.65%. I chose that because that's the current break-even rate. If you're comparing tips to treasuries, it's the best guess we have about future inflation right now. But if you want a copy of the spreadsheet, shoot us a note and we'll send you over a copy and you can adjust this to your own needs. So if you're in the inflation camp and you think inflation is going to normalize back to its historical average of 3.26%, you can make that change and you'll see that, well, the kind of the break-even point for investors goes higher. In fact, that appears to be the 99th percentile. So it's essentially what that's saying is if you invest in the 10-year treasury bond and you pay an advisor 1% to do it and inflation is 3.26%, you've got a 99% chance of having a negative real rate of return. However, things look different if you're in the deflation camp. If you think negative 1%, maybe your advisory fee isn't 1%. Things look different. Again, all you got to do is work from left to right to get a feel for what those probabilities are. I'm going to go ahead and set this back to where it was. Again, if you want a copy of the spreadsheet, shoot us a note. You can go over the formula that I used to calculate the synthetic returns. You can look at the historical accuracy of that formula versus actual index data of the 10-year treasury bond historically. There's other things on here that you can review, even the sources if you want to grab the data yourself and do some analysis. Again, my name is Eric Crittenden. I'm the CIO at Standpoint. I hope this has been helpful. If you want a copy, send us an email. Thanks for watching. Take care. Bye.